All right, guys. So this month we have Todd Ballenger, and I've known of Todd for a really long time, vice versa, but this is the first time we've really got a chance to interact. So Todd has been working in the with financial professionals for a long time. Financial planners, CPAs, not so much attorneys, right, Todd?
Not as much.
No, not as much attorneys. So Vanessa's more attorneys. And we also have Vanessa here, as everybody knows, she likes to deal with financial professionals and attorneys too. So this is more my conversation with Todd, but Vanessa's going to be here as like a co-panelist. So why do I think that it's really important to work with financial professionals right now? Interesting stat. So of the 4 generations, boomers, Gen X, millennials, and Gen Z, which one do you guys think is the generation that is buying the most houses right now? Boomers, Gen X, millennials, and Gen Z. Throw out some throw it in the chat, whatever it is. What generation do you think is leading right now? And it is boomers. You're correct. It was millennials for a long time, but boomers have surpassed them. And my theory why boomers have surpassed them in terms of the actual acquisition of homes, because boomers have the equity to win a lot of the homes right now. As much as millennials want to buy homes, as first-time home buyers, they're just getting their offers turned down. If you look at all the people that are winning the offers right now, it's the cash offers, it's the highest bids, and first-time millennials with 3% down, they just don't have that kind of buying power. But a move-up buyer, boomer, absolutely. So what that means is that we're looking for people that have assets. And generally, people that work with financial planners, financial professional CPAs have assets. They have somebody to manage their assets. They're paying somebody professionally to manage their assets. And so most people that they're going to refer to us are going to be people with some type of house or some type of assets that their financial professional says, you've got all this money, you need to buy a house. So they're going to qualify really well. That's generally true, right, Todd? Yes. And so how do we break into that market? What is the angle to break into that market? We're going to find out today. So Todd, if you want to, I'm going to remove you from the spotlight, Vanessa, and I'll bring you back. And then I'm going to mute everybody, except Todd, if you can unmute yourself. So Todd, I know you've been interviewed a lot probably, and we've all kind of done mortgage coach spots and everything. I do this a little different with my coaching group because it's more of like a coaching interaction. I'll lead it a little bit. So let's give the short, 2-minute version of your background and how you came to be. So people understand where you come from, why you're doing this, how you do this, and how you came about it. Let's start there, and then we'll lead it down the path. Go down the rabbit hole.
Sounds good. I was fascinated by money. And so I thought I wanted to be in finance or real estate. So when I graduated from college, I got my securities, insurance, and real estate license, started a financial planning company, ran that for 2 years. This is now, I'm dating myself. We're talking 1991, 92. We had a company called Capital Savings. So this was a traditional financial planning, investment, asset management company. Can you guys remember what happened in 1993? We saw a major drop in interest rates from 8.5%, 9% at that time down into the 6s. And we hadn't seen 6s for a long time. So we were meeting with clients who didn't understand the power of refinancing to lower rates, to free up cash flow, to create wealth. And I was fascinated by that. So something happened along the way. I realized that people were making bigger mistakes and the unknown wealth transfers they were making to banks and financial institutions because they didn't understand compound interest and time value of money and all these kind of things. They were making bigger mistakes on the borrowing side than they were on the investing side. So we, what I like to say, crossed the balance sheet and became lenders, which we later rebranded ourselves as liability advisors because we were financial advisors. We crossed the balance sheet to become lenders. We rebranded ourselves liability advisors, and we said, we're going to lend money, but we're going to help people borrow smart and repay smart. In other words, think about the strategy for borrowing and the strategy for repaying the debt to maximize wealth over time. So we wanted to bring financial literacy in as part of our lending differentiation. And that decision served us well. We built one of the largest mortgage companies in North Carolina. We did about $2 billion in funding. We grew in 9 states. We took that public in 1999. It was called mortgage.com. Myself, Garth Graham, who you guys may know with Strathmore, we're part of the group that did that. And then we started consulting, and we started consulting companies. It's going to be a 3-minute version. Our consulting company arose with the abolishment of Glass-Steagall. Glass-Steagall kept banks and financial services companies separate. When they collapsed Glass-Steagall, we realized that the banks were going to start buying financial service companies and the financial service companies were going to buy banks. So we started a consulting company to teach financial advisors how to start thinking about real estate and lending as part of wealth strategy. And we started doing that for Schwab and AIG and Ameriprise. And we had about UBS, we had about 8, 9 clients. And then we were acquired by a company called PHH in New Jersey. So we ran a kind of a boutique consulting company inside of PHH to teach this concept to thousands. We had 22,000 advisors in Ameriprise that we coached and taught about. And so we went out and did that. And then we started writing books and teaching this. And then we've come full circle now. We're back into the lending space, trying to teach liability advice as a concept to loan officers to differentiate themselves and all that kind of stuff. But that was the genesis of what you were getting out there.
So you come from, you literally come from the source where a lot of lenders would say, hey, we work with a lot of financial planners, so we're going to tell you how to do it. You're like, no, that's what we are. And we went into the lending space. So nobody really knows it better than us. We took advantage of it. So if somebody's going to know what we want, if somebody's going to know why we do what we do, if somebody's going to know how to talk to clients about getting a mortgage and why, it's going to be us, because that's really what you are, truly, right?
Yes. And that's just our genesis, our hero's journey that we jumped into. But for loan officers, I'll tell you that financial advisors perceive loan officers as someone selling debt. They perceive them as a salesperson largely, just as they perceive realtors as salespeople selling real estate. Financial advisors don't sell money. They don't sell investment products. Some do. Most of them are considered managers. They manage assets. They manage money. So that's where we said, we got to change the shift in the way we're being perceived. And all loan officers can do this to, I manage liabilities as a construct, because it starts to then, it takes you away from selling money, which is an anathema to the advisor. If I'm trying to make you financially independent and you've got 2 journeys, the one up the mountain and the one down the mountain. The one up the mountain is accumulation. The one down the mountain is distribution. Debt gets in the way of that. Cash flow is how most people are living their lives. So what you're doing is helping them understand, I'm going to help them borrow to get to their dreams of living in a house, not when they're 80, but now. The boomers are buying multiple houses now because they have the money to do that. But there's a lot of opportunity. There's $68 trillion in wealth for over the next 20 years, just to the Gen Z and that group.
Gen Z. I would say, so it's just a little bit of background. Oh, and so another thing I'm saying is like, why do we want to work with financial services? It's also smart to diversify your referral sources, because if you put all your eggs in a realtor basket, because let's face it, realtors right now are down 70% or more, then we're seeing this, but okay. And realtors are going to work a lot with millennials, because especially realtors are millennials, so they attract, but we want to always have this offset basket. And I've been saying it for years. Now, a little bit of history. I've had my experience personally working with financial planners and CPAs. I would say limited, but my angle, and I want to help you unpack this even greater, because I did it at a rudimentary level that worked well. And my framing was, you're an asset manager, I'm a debt manager. And so what gets in the way of building assets is debt. And so if we can work together, and by working with you, I can help your clients manage their debt better, we can optimize them more for increasing their assets properly. And that was always the introduction that I said, and it clicked to them. You use the word liability manager, I just use the word debt manager. We know that they go hand in hand, but we know that they're opposing forces, but they don't have to be opposing forces. And whenever I presented them to that way. Now that sounded really great in concept, right? But I think what I really want to unpack with you is some of the questions like, okay, but what exactly does that mean? Is my position necessarily helping them pick certain programs over another program? Is it me helping them deal with their other liabilities, like debt consolidation a little bit more? Or sometimes is it just a trust thing where it's like sometimes we don't have the magic solution, but I would still much rather have them go to you, somebody that I trust, than go to this person that, like, who the hell knows what they're going to put them in with all sorts of penalties and the wrong program and too much down and all that stuff, a little bit of that. And then you also have the CPAs, and the CPAs, they're always looking at, CPAs are interesting because they actually like debt in a sense because of tax breaks. So, oh, you got too much assets. We got to throw this into some debt so you get some interest tax breaks. But I guess what I really want to unpack is the angles. And because we have about 45 minutes, I know that you're this entire encyclopedia of weeks and weeks worth of information. But if we can pull 5 really great nuggets that my people can get a crash course, and then at the end, we can talk a little bit more about if that's what they want to learn out of this and take it from there, great. And then if not, there's more that you have at the end with your mortgage currency and everything. But what are some really key points of that relationship? Because you see what I'm saying? Like that sounds good in principle, but like where's the real immediate value working in financial planners? Or is it, like I said, is it trusting?
Yeah. So yeah, there's so many good questions in there. I'm going to go back to one of the first ones because I think the first question you have to ask yourself is why? Like, why would I work with financial advisors? And I thought of it as a 3-legged stool at existing customers, realtors, and financial advisors. Those were my 3 that was my 3-legged stool when I was growing my mortgage company and doing the business that we were doing. If you think about financial, first off, why would you do that? If you're working with realtors and you're working with clients, what I can tell you is you are on a roller coaster of rates because demand is driven by interest rates. You don't really make a market. You're a victim or a beneficiary of a market that's doing this all the time. Most of the traffic often gets driven by that. What we realized is when we started working with financial advisors, we could make markets. And when I say make markets, I mean that there are problems that they're trying to solve that they've never thought about solving with our tools, basically money, debt, borrowing, things like that. So what we would do is go in and take the common problems they were solving, cash flow and retirement or college funding or whatever. We would just learn about these products and say, there's a way to do that, or reverse mortgage or economic credit or whatever. So when we started building those relationships, what we saw was you had this cycle with your existing clients, you had this cycle with realtors, and you had this cycle with financial advisors. But the financial advisor referrals are life cycle driven more than they're rate driven. Whereas they're sitting there going, I've got clients that are getting married. I've got clients having their first child. Their whole world is life cycle oriented. And there's certain problems or opportunities that arise when these events happen. And guess what? Most of them have a housing component. My house is getting bigger. I need to trade down and get something smaller. I want to buy a vacation property now. So what we started seeing was—
Let me repeat that concept, by the way, because when we think about the real estate mortgage space, we think about the cycles of what interest rates are doing, what housing is doing. But to a real person, their cycle is based on their age. If they're 30 years old and it's time for them to get married and buy their first house, it doesn't matter what the rates are here. They're in that mindset, I got to buy a house. And so it's kind of irrelevant, right? They're going to buy a house at 6.5%, or they're going to buy a house at 4.5%. If they're at 45 years old and they're really started like getting to that last 20 years of retirement, they're going to start thinking about that a little bit more. They're going to look at their assets a little bit more and all those little things. Or they're 40 years old and their kids are approaching that college age. What do I do to save up for college? And so everything, that's why every single year, there's always a certain age group that wants to buy, that wants to do stuff, because it doesn't matter what the market is. It's their market. It's their timeline market. Right. And so we're looking at our databases, we're looking at our clients, we're saying, how old are you and where are you in your life? And can we help with that?
Yeah, 50% or more are getting divorced. And you don't say, I'm going to stay in the house with you for 3 more years because rates are high. That doesn't typically happen. But the advisor is sitting there and they're trying to figure out, how do I help this client? I'm going to try to avoid getting to all kinds of deep strategies and stuff to do that. But we would show them how, look, probably half your clients are going to experience this. There's a lot we can do to help you when that happens, right? We can help you with college plans. So they're thinking about life events as driving all of these decisions. I was always thinking about interest rates and stuff. So when I went to more of a life cycle, life event type planning mindset, and it really shifted the way I started to think. And that's one of the biggest reasons. It's probably the one that people don't understand. It's the most valuable reason to work with financial advisors. You get to start modeling, benchmarking another industry that is incredibly successful. And when we did that, we started changing the way we presented. We changed the way we talked about certain things. We changed about the way we position, because now we're working with them and we're learning from them, and it upped our game tremendously. And I've had people that have made this transition and they're like, holy cow, after working with a realtor and then now having 5 financial advisors referring business to me, the level of professionalism between the 2 industries are night and day. So your professionalism gets elevated because you're working with people that have a whole they're managing $1 billion in assets under management, small family office. That's different than someone selling real estate that's maybe working in a local house here in Boston, co-anchor office. And so your game changes with that, and that part's pretty cool.
And generally financial professional referrals, it's like, if I tell you to use this lender, you're going to use this lender. It's rarely questioned. It's not, okay, I'm going to talk to Khai, but then I'm going to rate shop him like 20 more people, because the financial professional will be like, what are you doing? I told you to use this person because you trust me with your millions of dollars or hundred thousands of dollars. So don't you want to trust me with this person that has, that understands liability management? So I have really three angles that I want to discuss. One angle is, because I think about acquiring new financial professionals to work with, but I also look at my database, right? Now, the angle that I want to address is that obviously I can go out and I can go meet new financial professionals and I can start, referral partnerships with them, just partnerships with them. But I also look at my database too. So that's a tricky situation when I look at my database, because there's going to be one of two situations. It's either the people in my database, I want to refer them to my financial planner, but they also could have a financial planner that I could talk to. Okay. Now, if they have a financial planner, am I going to assume that I'm going to want to work with that financial planner? Because what if that financial planner doesn't get it? You know what I mean? It's like saying somebody has a realtor, but do I really want to work with that realtor? Or do I want to play the game like I'm going to work with your financial planner? Or do I want to get close to that game like I have a better financial planner? You know what I'm saying? Because there's a database game and there's like the new acquisition game. But let's treat them separate. Let's start at the new acquisition. Let's start at the new acquisition game. In terms of, again, general techniques, I'm sure that there are very ninja techniques that I want to talk about too, like doing webinars and everything. But is it generally a lot easier to approach them, to call them, set up appointments? Usually what's best is to get some type of referral. Hey, we have a mutual client. Should we be targeting? Oh, I guess this is my question too, is that with realtors, I can literally try to target 20 realtors in an area. But with financial planners, are they a little bit more picky about that? Because I'm working with 10 financial planners or 20 financial planners. They want to feel like, wait a second, aren't you mostly working with me? What's the dynamic, the psychological dynamic with them, and who you work with and how many you work with? Is it territory based? Is it like?
No, but there's a word that you keep using, trust, that I'm going to reemphasize in a couple different ways, because clients go to where they're told in those kind of relationships, because there is trust. And that is also the reason that advisors will not work with you if they don't trust you, right? There's a burden of trust that you have to get through initially with them. But once you get through that, it's pretty powerful what they can refer to you. People don't realize how many referrals advisors actually control, because clients are coming to them saying, I'm buying a beach house, I want to pay cash. And they're like, okay. Once they've met you and they realize, wait a minute, I want you to talk to Todd first, because there might be a better option here. You borrow 80%. I make the payment out of an investment account we set up, and we reappoint those funds. But let's talk about advisors for a minute. When we say advisors, I've got another three-legged stool. I love three-legged stools. So advisors are a leg under your clients and realtors. Advisors are only three groups: what I'm going to call agents, accountants, and advisors, true advisors, financial advisors. And with agents, I'm talking about life insurance agents, anyone that is in sort of the life health group. We're going to talk about them because they have a different mindset. And that's where I typically coach people to start, because they're simple, right? I've had border collies, I've had labs. Labs are simple dogs, border collies are complex dogs, right? They're just different relationships, different needs. So the agents, the insurance agents, are cash flow focused. Selling insurance is easy. Khai, do you want to take care of your family if you die? That's not a hard question. Khai, where are we going to pay for this insurance? That's the hard question, right? So it's all about cash and cash flow, and how do I pay for this need that's there? But for that reason, they're great salespeople. They're really looking for people that can help them. And they're the New York Lifes, the Northwestern Mutuals, and all.
So, for example, they're big fans of refinances. They're big fans of shaving off a couple $100, because that couple $100 could be supplementing a life insurance policy, right?
Yep. And debt consolidation strategy, repositioning equity, with like you rebalance your assets. If you had suddenly 80% of your wealth was in Tesla, the advisor would say, whoa, we need to get you into some Apple and some
right. You're doing a move up purchase, and it's pay off that debt or put less down. You got some cash flow to give to an agent.
Put the minimum, put 20% down and reallocate, because you're overweight in real estate, and that may also increase risk burden. But so insurance agents, think of them as an easy point of initial entry. The trust barrier is lower. There's more lead activity. They're easier because they're going to try to sell you insurance. It doesn't matter. It's just all game. So then next would be accountants. And accountants are interesting because they're always looking for ways to increase the value of the customers besides just doing a tax return, especially with business clients and ongoing relationships. But with them, you've got a cycle. Do not call on them until after around June 1st. And you've got a window where they're bored between June, July, August, September, October. And they're looking for stuff to do. They'll sit down and talk to you, and sometimes you can't get them to stop talking. But don't try to call them the rest of the year. But they're fun because they're looking for ways and they're looking for resources to say, I've got a client who's getting divorced. Or I've got a client who's just sold their company and they want to buy a house at the lake for $3 million. And they're asking me about, do I put it in an LLC or not? They want resources to answer these questions, and they don't want to call just some random.
Yeah, they want to do some collaborative value because they're bored during that time. And if they can provide value, it's good for retention. They'll get some referrals or whatever that.
Yeah, you charge $150 an hour for my time. I'll create a nice report, a TCA or whatever. I'll do this analysis because I'm going to win the opportunity here to do business with this client. You're going to build me out. And that's a really cool opportunity for them.
Yeah, that's true. I get my CPAs billed all the time. So some of them, a lot of them are getting more billable hours too.
Absolutely. And that's where you're focusing. That's the hit mine nerve. People are always asking, hit mine wallet, how am I making money?
I think we have to remember that we're not talking about like the H&R Block accountants that do your tax returns for $200 once a year. We're talking about real CPAs that charge an hour, that I literally get billed a couple $1,000s a month for doing all my accounting and payroll. When we're talking about accountants, we're not just talking about like tax accountants. They're handling payroll. They're handling bookkeeping. They're handling people's businesses on a monthly basis. And so between June and October, they're doing less when it comes to taxes. They need some more billable hours. So they want to talk to you about, what are you doing for your mortgage? What are you doing about your interest savings? What are you doing about debt consolidation? Things like that.
Absolutely. And yeah, it's so hard not to talk about strategies, but we took the CMG product into accounting firms that were doing business planning with Ameriprise and showed them how to create interest-free mortgages for their clients. So you can take strategies and products into certain networks like that, and it can blow up. We did $3 billion with a CMG product doing that. But then you got advisors. Now, advisors, that's your Ameriprises, your Schwabs, your Merrill Lynch's, your LPLs, your Edward Jones, all of those different sort of brands are people that are traditionally their wealth advisors. And they're managing a book of business, a book of clients that they meet with under the Know Your Client laws. They have to meet with them quarterly, but no less than annually. There's a constant dialogue going on there. And and this is just, it's unfortunate. Most advisors don't even put real estate wealth on the financial plan, right? They look at it as necessary evil, but 86% of Americans have the majority of their wealth inside their house. 86%. Goldman Sachs has shown the breakdown of this. It's on our site. We've got charts on this stuff that we can use. But at the end of the day, there's so much wealth in the house that's not being managed, and the advisor isn't managing it. And it's why we call it the three-sided balance sheet. There's assets, liabilities, and real estate on every balance. Right. And it's really three-dimensional, right? Because real estate's an asset and a liability, no matter whether it has a mortgage or not. But financial advisors manage assets. Realtors sell real estate. You've got to decide if you're going to sell money as a mortgage lender or if you're going to manage liabilities or debt on the other side. We just went from debt to liabilities because it expanded the opportunity. We consider it a liability unknowingly and unnecessarily paying twice what you need to pay for a house because you financed it poorly. That's a liability too. It's just an opportunity cost liability. So we tried to expand that a little bit over time. But at the end of the day,
so to recap, you said agents are cash flow driven. They're generally the first one. Accountants are calendar driven between June and October. So with advisors, are they driven by one thing, or are they like a more overall holistic approach to them?
Yeah. So yes, great question. So the accountants are impact. They're certainly calendar driven, but they're impact driven for their clients. And they really do like that opportunity to bill out for additional time if they can do that, because that's how they grow their practice. Then the advisor, think of them, they're holistic wealth managers, but that business has shifted so much. They're really not managing wealth. They're managing a relationship. Most wealth management now is done by the financial services company. There's no longer an advisor sitting there picking stocks and stuff. Their money comes in, it goes up. There's a TAMP, there's a big Ameriprise, Schwab, whoever. They have these huge asset allocation models. That person's money gets spread out across ETFs and all this kind of stuff, and it's managed by the firm. They're relationship managers. And for that relationship management, they're earning anywhere from 0.75, 75 basis points to 1.25, 125 basis points of the assets under management that they have there. Okay. So one of the first things that we teach you, and if you haven't done this before, you want to know what your liabilities under management are. That's every loan that you have in your book of business for your clients that you're servicing today. Some of you on this call may have 100, 200, 300 million in liabilities under management. That's loans you've done from your clients you're working with. So when we're building a relationship with the advisor, we're actually talking to them saying, I understand you have about 185 million in assets under management. That's cool. I have about 300 million in liabilities under management. So again, boom, and this is a mind blower for them. They're like, what the hell are you talking about? That's the business that I've done with clients that I actively manage. What does that mean?
You take your database and multiply the loan amount. That's the liabilities I'm managing.
That's simple. That's right. Absolutely. And then you're saying they're going, we do annual reviews. No, do you? I said, we meet with our client annually to make sure they're on track with their goals, with their borrowing and stuff like that. So again, completely, not only you're not disintermediating your competition, you're making them wish they've never competed in this particular arena because you're a liability advisor, you're doing liabilities under management, you understand what they're doing. That advisors about wealth creation over time, but ultimately they're a relationship manager. They want to maintain that client through showing value to earn their what? Their 1% annual fee. Unlike you, the difference is their asset under management is accretive, and the bigger it gets, the more money they make.
So what you're trying to impress on them is, that you are also a relationship manager when it comes to liabilities. And these are the things that I do to manage my relationships. I do annual reviews, I do rate watch reports for them, et cetera. And so you want to say that we're the same type of person because we manage your relationships and we're always in touch with these people. And let's talk about doing business together. And it's not exactly a straight impact or cash flow angle. It's just getting them to understand that like you manage relationships on assets, I manage relationships on liability. We need to be on the same page, but let's also have lunch and let's be cool and let's like each other and maybe hit a Dodger game or something as well too. And let's have fun. And then that relationship just begins the bond. Cause that's how it was with my Ameriprise manager. It was just to the point where we're just good buddies. And then it was just one of those things like, he was like, hey, I'm working with this person. I want you to talk to him.
Absolutely. And slowly they're like, hey, I've got clients coming in for annual reviews. Would you mind if I sent some of them to kind of look at? Cause I'm concerned that they have too much wealth in their house or they're buying a house and they just sold a house and they've got $1 million. I think they should invest that $1 million. I don't think they should pay cash for the new house, but they don't know how to talk to this when they have a partner. They can say, let me run the numbers for you. Right. Or let me go through and put something together and talk with them. It's not them selfishly saying what I want the $1 million, but you're saying, hey, if that $1 million compounds at 7% for the next 30 years versus paying cash for a house, what's the financial impact? Well, you might show them that's going to cost them $2.6 million to do that. Okay, that gets attention. It gets the advisor's attention, the client's attention. But think about it this way. At the end of the day, you need them to trust you. Okay, that you're not going to make them look bad. And secondarily, that you can help them solve the problems that they're already trying to solve in a new way. Yeah. If you say, I'm retiring and I haven't saved enough for retirement, and I can say to you, have you ever considered a reverse mortgage? I'm solving the same problem they're trying to solve, but with a new product or a new strategy that they may not know about, or they may have a lot of misconceptions about, where you get a chance to show to them, hey, you got a $2 million house over here. That's a big part of their wealth. Can we use that as part of what we're doing for the overall plan? So you become a trusted advisor to the financial advisor on the liability side of the balance sheet, in the way you ultimately are building a relationship where they become a trusted advisor to you for certain types of clients. And this is back to your original question, because I get this a lot. What happens if they're like, I want to partner with you, but I want all your referrals? I would be like, that's malpractice. That's like me sending everyone I know to a chiropractor. That's not what you do. If you're the best chiropractor, I'm going to send you all the chiropractic business I can. But I've got someone that needs surgery over here. I've got someone that's got a torn ligament in their arm. There's different doctors for that. And this is where, when you start building relationships, you realize Ameriprise is mass affluent. They like clients and they're certain 250 to 750. Merrill Lynch wants $1 million and above. Everybody Jones just wants a family relationship. When you start to build relationships, you become a sorting mechanism for clients to get them to the right people. Just like I would tell the advisor, don't refer the client to me if I'm not the right person. And if it's someone that's not serious about their money, they don't really care about the value that I'm providing, then just get them to an online lender or something, get them to Rocket if that's what you want. But if you want someone that's going to take the time to meet with them, help them manage their liabilities, create the lowest cost of homeownership over time, which is a lot of time for most people because we live indoors most of our lives, then I'm going to be the right person. I hope you'll refer to me, those opportunities when you can.
Yeah. Todd, I want to answer one of these questions. So Chris asked, what would be a good strategy for advisors when a huge part of your database is first-time home buyers with little equity? So my first thought is what you said before, there's not a lot of people that are necessarily in the position to work with advisors, but they would work with agents for life insurance, maybe CPAs. You know what I'm talking about? These are probably the younger millennials that are getting out in the world. They don't have a ton of assets. Is there anything that when we're working through our database, is there something for these people that we're recommending financial advisors or anything to help them with? Or in general, are we not really focusing on that demographic?
No, well, you absolutely want to focus on that demographic, because if you're in this for the long game, right, those people are going to be upwardly mobile. You have what's called the financial world is called Henrys, which is a high income, not rich yet. Henry,
Okay.
that's doctors and lawyers and people that they come out of school, they're starving, but they're going to be a really cool client for you. So you have these different sort of stratas of people. The reason the number one reason people don't use financial advisors is fear. And it's fear of a particular type of fear. It's embarrassment and judgment that they haven't done enough or they've made bad mistakes. And to avoid hearing that from a professional, they never visit them. I'm afraid to go to the doctor because he might tell me I'm sick. He is the cure. He's going to give you the medicine to make you better, but I don't want to go because I don't want to know. So your value becomes, as you build this network, you become more and more valuable. And if you've got a lot of clients who are first-time home buyers, you're going to meet certain financial advisors that will gobble them up. They love working with young couples that are just starting out because they want to build a long-term relationship. Edward E. Jones comes to
it's no different than newer realtors that'll gobble up all the first-time home buyers. Right?
So,
you're going to have a lot of newer financial planners that'll say, I'll work with these people because this is going to start my portfolio. And that newer financial planner will throw you a bone here and there because they're going to have, again, their own somebody just setting up their mutual fund and everything for the first time that wants to buy a home. They're going to send them back to you.
Yep. And just like lawyers have paraplanners or paralegals, right? Financial advisors that are grooming, like in the Ameriprise system, there's P1s, P2s, P3s. A P1 could be a salaried advisor that's getting started, and they have to build their book to a certain size to get to the kind of the P2 level. So in the bigger firms, they actually are looking for these starter clients that they can practice and build a relationship with. And they don't want to deal with them, but they want to get that person and build that person up to the next level. So again, your value in being able to know the right fit for that client is huge, because it can make the difference in them disintermediating themselves and not doing it and meeting with the right advisor and going, wow, they didn't tell me I was stupid or that I was waiting too late, that I can start now, and that there is a path forward, and that there are some mistakes I'm making, but they're correctable and they can be adjusted. And
you can say the same thing with accountants, because you have your accountants that, like my accountant, he's a high level accountant that basically works with business owners, self-employed business owners and celebrities and things like that. And you got like accountants that are going to work with your middle class, upper middle class people. And so I guess what you're saying is it's not just financial planners and CPAs. You have accountants and accounting firms, and then you have new advisors and more established advisors. And then you have agents that are going to be at a different level. And so understanding the 5 different types and understanding how they look at different life cycles. So like a newer advisor, it's probably going to be like your more younger 30-ish something, and your other advisors might be dealing with your 50-something-year-old clients, right? And so once you have an understanding of that, you all understand like the life cycle and the demographics of who you're going to work with, who they're going to refer, what you're going to refer to them. And obviously we started this conversation looking for some move up buyers, right? The referrals from the more established advisors might be a little more valuable to us. Not that we wouldn't turn down one from a new advisor. So then, Todd, when we first talked, I want to unpack a little bit more as we're going down the last 15 minutes. I had showed you this photo, and it's my approach to building a business. There's sales on the bottom and there's marketing on the top. And sales is short term in the sense that it's a sniper mentality. We're gonna sniper. We're gonna call and meet with different financial professionals to get an appointment, to display my value, and we're going to sell them. And then there's marketing. How do I market and how do I attract them? Whether it's through social presence, whether it's through ads, whether it's through seminars, whether it's whatever. And there's really always two approaches to business. So I like the way that you answered my last question, which was like, if you look at the financial planners, I would go after agents first because they're the easiest, and then accountants, then advisors. So that I would say to you, for somebody looking to really break into financial professionals, where would you start first? And then where would you go second? And then where would you go third? Because like for me, I love marketing, but I tell people that's not where I go first. First is you have to do sales. You got to call your family, your friends, you got to ask for referrals because you need some short-term business because you got to pay your bills. You got to keep the lights on. But the long game is to play marketing. So what is your sequence to really break into this field? Where do people go first, and then the second, and the third? Like, how do you help an originator build, let's say, a 3-year plan, like in sequence, build them up to top level?
Yeah. Okay. So I'm going to give you a summary of we call our FAST model, which is Financial Advisor Success Team, which is, it was a model we built out for financial service companies originally, but then we started using it ourselves. So you have a treasure within your existing database. And this is kind of a question you asked earlier, right? So how do I make warm calls with a high probability of that advisor, agent, or accountant taking my call? And what we found over time was I called because we had something in common, and that was a client. And calling with a particular kind of a script, which is I was talking to Khai McBride, and I realized we both work with him, right? He's a shared client, and he was telling me a little about what you do. And I'm always looking for top professionals that might fit some of the needs of my particular clients, bastardizing my own script. But you know what I'm trying to say here is,
and by the way, here's the backup script that for everybody, what you can do is you can call every single person in your database, or you can send an email to your database and you can say, hey, I'm looking for a good financial planner to refer. Do any of you know a financial planner that you would rate at least 4 to 5 stars? Let me know. You'll get some referrals from clients, or maybe you're just doing an annual review and you say that at the end, hey, how would you rate your accountant on a scale of 1 to 5 stars? How would you rate your financial planner on a scale of 1 to 5 stars? If you get those 5-star reviews, that's now your warm lead. If you call a database of 200, 1,000 people, there's no reason why you can't get at least 50 warm leads from people that said they love their accountant, they love their financial professional, they love their insurance agent. Now, what you're saying is you're making that call, you're making that introduction to them. And so that's really like the first place, the easiest place.
Yeah, we have a form. There's 6 people on the wealth team: the loan officer, financial advisor, the realtor, the insurance agent, the accountants, and the attorney. That's your core wealth team. And we're asking them to say, would you tell me who that is for you? And just like you said, we do a scale of 1 to 10, still 1 to 5, but same thing. And what we're really looking for is 7 is the equivalent of fine, as they say. That's the F word, right? So anything below a 7, I want to replace them with an 8, 9, or 10, right? It's a little bit of a game. You got clients that don't have anyone at all. That's an opportunity to come back to that client. If the client says, I've got this guy at LPL and he's a 9, that's someone I'm going to go meet. You know how I'm going to meet him?
You're right.
We gave you
if they rate them low, then they need somebody that you can refer. If they rate them high, I want to meet that person. So you're going to get a list of all your 7s and belows, or in our world, 3. The reason why we switched to 5 is the social world is 5 stars now. But anybody 3 stars or less, this is a list of people that I can refer to people. 4 or 5, these are lists of people that I want to meet that person. Right.
Absolutely.
And so I like what you said. There's can you name the 6-person wealth team again?
Yeah. So financial advisor, insurance agent, accountant, loan officer, realtor, attorney. Some people add estate planner as a 7th because they're different. And they have different ability. And some people will add like a divorce attorney, which is also a specialization under the attorneys. But those 6 are where we're starting out initially. But
even having that conversation with people, it's like when you're meeting with people, it's like, hey, listen, most people have a 6-person wealth team. I was referred to you because, and I want to help this person build the team, or I'm looking for somebody to add to the team. And this is just common language now that you connect and build rapport with these financial planners.
Absolutely. And I will tell them, I'll say, look, you may not need all of this team now, but you will need everyone on this team at some point in your life. So would it be great if we had a team of people that were 8, 9, or 10s, preferably 9s and 10s. And if you don't have them, if it's okay, I'm going to try to introduce you a few people. So you're telling them, I'm going to get back to you and make recommendations here, which now gives you the collateral, the goodwill to introduce to the right advisors and agents in these different spaces and different needs, and vice versa. But
literally, I'm looking at everybody on this call. You can start today And this is very short term, but you guys can start today. You can call your database of friendly people that know your name with zero resistance. You can ask them the 1 to 5 star question that I'm looking for a financial professional in this area. I'm looking for an attorney. I'm looking for CPA. I'm looking for an insurance agent. How would you rate yours? And then if it's like 1 to 3, say, okay. If it's 4 to 5, I would love to have that person's name because I'm looking to refer clients to great people like that. Absolutely. You make 2 lists. Now you go down the list, you call all the 4 to 5s. It's the warmest call. We have a mutual client. They raved about you, feed their ego a little bit. They talked about some stuff. I'm always looking for people to build my wealth team. I am a mortgage person, but I consider myself more of a liability advisor because I realize that's the biggest that everybody's going to take. And so by managing it correctly, I can increase cash flow. I can redirect assets. I can do everything that supports your cause. That would be the script. And I also, as I was looking for somebody, I created a list of 167 people that rated their financial professional only 1 to 3 stars. So if there's also an opportunity for you to work with them, this would be great. You can do that for the next several months.
Every
a lot of opportunity.
Every new person you talk to, you want to collect that on because you just increased your potential to call 5 or 6 new people in that relationship. You obviously want to have the spot that's the liability advisor. We put that on there just because, again, I'm rebranding from mortgage lender to them just to make sure they know that's what I'm going to do. I'm going to meet with you long term. We're going to help you manage your liabilities, your debt. When you're thinking about paying off the mortgage or paying extra, I want you to call me. We're going to talk. You're setting, and then you've got other people that you're going to need to help you along the way. And I want to make sure you've got a great team to do that. It's a very soft thing. Call into your database, make sure new people you're talking to, you're incorporating that into your approach. And you can stay in the one market forever because once you get
it's a very pleasant conversation. So we got about 10 minutes. I want to leave the last 5 minutes because I do want you to talk to everybody, let them know what you do. But I have one more question, which you can have about. We're in a marketing world today, especially a big social marketing world. And when I work with people and they say, how do I meet a realtor? Especially we had a question yesterday in one of our groups from Patrick. He said, how do I go out to a different area and meet a new realtor? He said, because I'm not local. I'm like, you're thinking the old way. I do coach a lot of older generation. I'm an older generation, so I'm making fun of myself too, right? So we always think that we have to meet people in person. It's not necessarily. If you want to meet somebody in Arizona, the new way to do it is we start following people on social in Arizona. We just we create a digital presence in Arizona, and then we start marketing that person in Arizona. Okay. Yeah, Patrick, you know what I'm talking about. But anyways, so if I were to really market to financial planners, just gain their attention from a social point of view, from a marketing point of view, from a video point of view, we're out here doing videos which attract homeowners and realtors. We talk about down payment. We talk about closing costs. We talk about things. What are some topics that we would talk about that would catch the eye or let a financial professional really look at us differently? Is it just maybe some keywords and some key items when we talk about maybe debt consolidation or certain down payment requirements? Like what would attract the attention of a financial professional if they were to randomly watch a lone person's videos and marketing and presence that would key them to say, this person's a little different? Like what type of language, what type of marketing would we do?
It's a tough question. It's part of the reason that our model that we teach and coach is it's very similar to what we're talking about. You can build markets and they don't have to be in the same state. They can each one in the same country in most cases. But advisors tend to filter a lot of that stuff out as best they can. Because again, they already have such a predisposition to believing someone's selling their client money or whatever. That's when we found if you can sit down with them and get permission to market to them, they become very receptive to the marketing. And they want the studies, they want examples, and they're willing to look at them, and it just opens them up to more and more ideas. But again, largely we found it's case studies and how you've helped somebody before that. Case studies, it's problems that we're solving. Like we publish something, we do a whole kit every month on a particular idea for advisors, like IRA stretch, how to help clients stretch their IRA in retirement. That kind of stuff, if you tie it to something that they're already familiar with, will get their attention. Trading down was one we recently did, where we're talking about the power of selling your house and buying something smaller, which reduces your cash flow needs in retirement, creates a lump sum for additional growth. So we'll target a particular financial planning concept or idea and talk about that from liability management. If you go straight liability management, debt consolidation or things like that, sometimes they'll get it. A lot of times it just becomes noise, like low rates.
Yeah. Again, it's like but we can expect that from marketing. But I guess to me, marketing isn't always about convincing something of something. It is branding, because maybe I don't meet them that way, and I actually meet them through a personal conversation. But when they actually start following me and they start to see the branding, and they can look at their clients and say, hey, you really need to follow this person, because listen to what they say. It's not like a normal lender just trying to feed you rates. Look how he's so concerned about your financial well-being and your asset position, your liability position. So maybe it's not always attraction marketing, but it is branding marketing and solidification marketing. Yeah, it's awareness. And that's the thing about marketing that I don't think people understand. Marketing, we can't always treat marketing like it's going to immediately lead to a sale, because that's not the entire purpose of marketing. Sometimes our marketing is there to actually retain relationships that we have. And it's just for our financial professionals to look at their clients and say, just follow this guy. Because maybe if they get one of their clients to follow me, they may not need a loan now, but in 2 years, when they're still watching me on social media, then it's gonna spark them. And because I'm talking different than not some online lender, it's gonna be better. In the last 4 minutes, Todd, I'll give you a little bit of the platform. You want to talk a little bit more about what you do with your, we'll call it your online university and programs and everything like that, that people that really want to go deep into this topic?
Sure, man. Yeah. So we created a certification program internally for our loan officers as a way to differentiate the ones that were really committed to learning this stuff. And we had a certified mortgage planner, certified mortgage specialist, certified liability advisor. Certified liability advisor was our top internal designation, and we continue to work with that over many years. So it's a course, it's a program. You get your CLA designation. It's about 30 hours of coursework.
Okay.
Community. And that's one place you can learn about that. On our website, Morrismart.
So it's kind of like it's like a boot camp course, for lack of a better word. It's for a short period of time. You learn a lot of the basics. And I guess what is really beneficial is you'll learn a lot of terminology that will really make you sound and connect with people better. It's a one-time price. So you just make it through, you get certified. We see all the other ones, CMA, CMPS, we see all those ones. So you have your particular one. And then you can send that to me. You can either email it to me or you can put it in chat, because we always send a summary of these calls. And so it'll go out in the summary of all your information. If you can email it to me, that'd be great.
I will.
So that's probably, again, I like the way you think. That's probably like a good first step for people, right? It's not necessarily, it's like a short-term commitment. It gets you from here to here in knowledge. And then you can really go out yourself. You can go out and you can arm yourself better with that.
Absolutely. Yeah. There's a rabbit hole with 3 levels. We say, if you're just curious, there's so much you can learn getting the designation. And the major pivot there is transition yourself from, again, a loan officer to liability manager. And financial literacy is really foundational, because people don't understand the power of financial literacy as a tool when you make that shift. And that's a big focus of what the CLA is. The next level down the rabbit hole we call FAST. That's our financial advisor success team, where you're building a team internally to support that leg of business. And it's how we did it with Ameriprise Law and stuff, but at a very granular level, the scripts, the step-by-step. Yeah.
Is that a level 2 anyways? Like, you still advise the first one before you go to the next one?
I always do. Yeah. We'll jump into that, but then they realize that a lot of the language and when liabilities under management and all that kind of stuff, like, what's that? We did all that. Yeah. Like foundationally. And the big shift there is, and I tell people, don't do that unless you really want to work with advisors. And your goal is, say, 2 to 3 years from now to have 50% or more of your business coming from those 3 groups. And you can do that within 3 years easily. And you're making a market, which is not, you shift from being defensive as a loan officer, which a lot of, when I say defensive, it's like you're dependent on the market. You go into offense and you make markets. You do it.
Anybody who's dependent on the market, you're going to be average. And I love what you're saying. We're making our own markets through marketing and through niches that are lifespan based or lifestyle based, not market based and rate based.
Absolutely. We call it shaking the money tree. We're going after the strategy, and 1.8% on average of the database that sees that will engage in some way. And then another strategy and another strategy. And each time you've got your normal flow of business from your clients and realtors, but then you're actually making a market through these partnerships with advisors who will say, hey, that's a neat idea. I want to share this with my clients. And then from there, it just moves into people that really want to go deep with this stuff. It's more of that personal coaching, but it's like, I really want to grow this. We had a kid just took our CLA class, was calling on a financial advisor to do the interview process. The firm had $800 million in assets under management. And they're like, we will finance you to start your own mortgage company. We want you based here. We've got 2,000 clients. And so again, opportunity dances when you're on the dance floor, but we're seeing these things happen where people are partnering and they've got regional office for TI Craft, and they want him to come in and talk to teachers and police officers and things like that. This stuff happens, but you're getting into a whole different database, a different set of people, a different set of circumstances, which can't help but increase your own personal growth, and you grow yourself, your business grows too.
I love it, Todd. So I'm just going to summarize this. So the steps to take right now is call your database for 1 to 3s and 4 to 5s. Okay. And then from there, you have your step level. You like your agents first, then your accountants. And then from there, you got your advisors, and there's obviously different levels, but that's your pecking order in terms of ease, because you got cash, you got impact, and then you have long-term wealth. And then also in terms of bettering yourself, number one, you can just listen to this webinar, take it by itself. If not, you can get the certification. And then if you want to go a little bit deeper, you can go into the more in-depth course, we'll call it, right? Certification. And then that kind of summarizes today's call. And I love it. And I hope I opened up a lot of people's eyes to another pillar of business, because a lot of the conversations that I've had lately is, man, we just deal with realtors that are struggling too, or we're getting people with first-time home buyers and we're getting outbid because they don't have enough assets to bid. And it's the boomers are taking all the deals because they got the assets. And so how do we break into that market? This is it. It's working with financial planners. And obviously the ones that, again, the newer ones that are dealing with your first-time home buyers, that's still great too, because we're still going to work with them. They're still going to give us probably more first-time home buyers. And we need that. But as you can work your way up to the more experienced buyers, and once you can go to Bar Smart University to get that certification, talk better, and you can work your way up, then you'll start getting the more higher equity, affluent clients that will have that asset position, which are the better clients that we want as well too. In this market, it's the better clients that we want in this market. So
yeah, advisors are not struggling. They are having their best years ever because asset prices are just kicking butt. And again, just if you guys don't do reverses, things like that are the types of things where those products are going to solve the problem. There's no other way to solve it. And the people that you're going to solve that with are going to be advisors. So there are a lot of niches you say there that can lead to some riches.
Yeah. Again, guys, when I talk about the modernization of your mortgage practice, the modernization of your mortgage practice means, are you addressing modern times? And in modern times, when there's so much adversity in first-time home buyers without enough assets to really win, and just everybody falling rates and everything, the modernization is recognizing the niches that are winning, the niches that are the big opportunity, the niches that are winning. I bet you that if I looked at the 350 listings that are available, and then if they close, I bet you a big majority of them were the people that had cash assets that could outbid everybody. So you have to look for people that are in that cash position.
Yeah, it's almost 40% of the purchases last month were cash purchases. So that's,
there we go. So we got to take a look. And here's the thing, maybe it's a situation where that financial planner is going to have that cash purchase buyer, but then there's also other referrals from them where they're going to be the 20% down, the 40% down, the 50% down as well too. You're just creating that relationship with them. So Todd, thank you so much. You were really helpful, and hopefully a lot of people will look into your certification. I think that will really help a lot of people and make them be smarter and everything else. And everybody else that didn't show up, well, you'll watch the recording. So thanks for watching the recording. I thought this was really great. We will keep in touch. I think there's a lot more we can unpack with this in the future working together.
Sounds great. I appreciate it.